everybody trading liquidity concept nowadays. But did you know that all the liquidity patterns don't hold the same value? Some of them are extremely powerful to learn about, while others, you can just trade it. Most of the time, they're not that much profitable either. So what are these patterns? How do you take advantage of them? Well, in this video, I'm going to show you exactly that. I will firstly go over the very basic type of liquidity patterns that happens every day and every time in the market. Then I will show you the most powerful type of liquidity patterns that you have to be aware of, that can give you great returns if you know how to use them on your advantages. By the end of the video, trust me, you will have a wider understanding of all these liquidity types. As a bonus, I will also introduce you to a new emerging type of liquidity that everyone is talking about, but not many have understood the importance or how to use it. Alright guys, so before I break you down all the different patterns, I want you to pay close attention to what I'm about to share with you, because this is why most of the people nowadays are focusing so much on trading liquidities. And everything actually started back from almost few years ago, I would say probably even 10 years ago, right? So the first thing you can see over here, I say evolution of traders over the years, 3 key patterns that evolve all these strategies. So what do I mean is that when trading became available to all the retail traders, like I'm being 10, 15 years ago, majority of the people couldn't get access into it because you needed large fund, you needed a lot of different approach for you to get access into these big brokers, into this big pool of liquidity and everything in order for you to have capital to trade in the Forex market. So what happened is that when the first type of educations came around and the retail trader, the so-known retail trader, they started learning all these type of simple concepts, simple patterns that a lot of people are still using nowadays, and which is absolutely fine. So what are these patterns? Like support, like resistance, then you have the trend line, then you have also the channeling. And what happened is that most of the people, probably majority of the trader at that timing period, so I'm saying like 10 years ago, let's say roughly like this, were all focused on this. Some of them they're trading harmonic patterns, some of them were trading like flag pattern, like whatever you want to name it. However, over the very next few years, like what happened, like let's say 10 years, let's say last 5 years, something started happening in the market. People that were trading this type of patterns, this one and this one, they started noticing something particular. That actually, it has always been in the market, but most of the people started realizing it since the retail trader are the one that were influenced or losing money because of it. So what was that? Was the so-called fake out happening within their specific pattern. So if they were trading support and resistance, they started noticing that price were sometimes doing this and then running away to that desired directions. And then the same for the trend line. You get 1 touch, 2 touch, 3 touch. I'm pretty sure if you trade a retail concept like this, you definitely have came across it. So if you had trend line, most of the time might went for a buy because price was telling you the 3rd touch was about to happen. But then the next thing you know, price was taking you out and then it started going to the other direction, right? So now this is not something that actually started happening 5 years ago. No. This has always been there. But the fact that majority of the retail traders, majority of the people in this society that started having access to it, they started realizing that, okay, I'm trading this type of patterns, but for some reason, most of the time, people were getting taken out and then the price was going to that direction. And this started creating a lot of frustration within the trading industry, right? Within all the retail traders. So then what happened is that over the next few years, and now we are going very close, let's say around 2018, 2019, that was the beginning because I was one of the first that literally started learning the second evolution, that's how we'll call it, evolution of traders, retail traders that came into the market. So what are they? Who are they? Well, this retail trader, I actually call the retail trader with the SMC concept, the smart money concept. So this trader, what they started doing is basically they started learning and understanding how to take the advantage of a particular situation, which is this one over here, right? So you got support, you got resistance, price takes you out, and then, it stops you and it goes to your direction. So what they did, or people that, came up with this concept, in this case, let's say ICT himself, because he's the one that, if you guys know him, well, he's the one that created smart money concept, whatever. But then, again, there are so many people that started talking about this concept, and I started learning, I was one of the first that started learning this concept in 2019, and they came up with this, okay? So this pattern over here. So what it is, well, this was widely used from 2019 to all the way, let's say last year, probably 2021 or no, 2022. And then what started happening over here is that people try to understand how they can avoid this. So the way they started doing it and what they started noticing is that this pattern, so in this case, a buy scenario and sell scenario, and the same goes over here as well, right? This pattern over here was the one that they should be trading instead of trading support and resistance, or instead of trading channeling or, let's say trend lines. So what is this pattern? Well, simply having the support, the resistance, waiting for price to do what? To take out the liquidity, okay? And then as soon as price take out the liquidity, they started noticing that the price breaks the structure to the downside and then mitigates, okay, these orders over here, and then it gives a very, very nice and clean entries. So now this started becoming a very nice, let's say, trend going across all the traders on social medias, on YouTube, on everywhere else. So obviously you can imagine that most of the traders that were here, and I as well myself, when I literally started at the beginning, I probably learned about this support resistance, all of it, probably a couple of months. But then I got, I wouldn't say lucky, but through a lot of research online, I started coming across with this type of concept, which is my money concept. And I started learning about it. I was like, okay, how do I take the advantage of what's the difference between this and that? Then I realized that these traders over here are literally waiting for this to happen, while these traders, they just take it based on the pattern they see, okay? And so far, so good. So then what started happening is like a lot of people from here, they started shifting over here. And now you can imagine by having this shift, this is bringing tons of liquidity in the market towards this direction now. Why? Because now people are not majority, I wouldn't say majority, but quite a good amount of people are not taking any more trades based on this and this. They're taking trades based on this, right? On the mitigation. So that means the people entering here, their stop losses are above this zone. So there is a ton amount of liquidity over here. And you can now imagine and guess what happened next. And this happened literally fresh, like literally last year. Well, guess what? This started happening. We started having a new wave of traders coming to the market, which is so-called the retail trader, like fake out or like an inducement trader, whatever you call it, fake out inducement is the same thing. But look at this. That's what started happening next, which is this pattern over here. So now, this is something that usually used to happen even before, like from 2019 to 2021, 22, I used to see this pattern happening, but recently, lately, this happens even a lot. Why? Because me, as I said, I mastered this one over here, and this is the one that was trading a lot, and then I started having this happen a lot. So this is the generation, and I'm talking now, up to date, this is the generation where people are trading this, or they're trading the inducement, the fake out itself. So before, they couldn't trade this one. They traded this one and they got stopped out. Then they couldn't again trade this one. They were waiting this to happen and then trade the mitigation. Well, now everybody are focusing on this. Well, I think you might be watching this now thinking like, okay, I think that's probably the most obvious and the right things to do. Why? Because now you're trying to take within the fake out. That means that when fake outs happens, you jump in the chart and then you take the trade because you know that you're now literally following step by step the institution, right? While here you are following the patterns. Here you were waiting for the institution to do something and then reacting according to it. But now everybody started going towards this direction, which is the third wave of traders over here. So what they do is that they aim to take literally the fake out itself from here or from here. Why from here? Remember the one I said before over here on the smart money concept? A lot of people take the trades over here, they put the stop loss over here. So there's a lot of liquidity. That liquidity now gets taken out as well. And then price runs to the desired direction. So you might be thinking, oh, well, that's beautiful. If I do this, the third one, then I'm definitely going to be profitable. Or I'm going to be, consistently making good returns because I'm trading with them. Well, I'm sorry to say that literally, but that's not the case. And I'll tell you at the end of the video why I don't take this type of trade. And I'm still sticking myself to this type of wave over here, which is a smart money concept added with supply and demand concept. And you guys can see I make a lot of videos about it, right? And I'll tell you what are the advantages that I see on this compared to this one. Because this one over here, trust me, it's going to destroy a lot of traders. I know it sounds crazy because if you do trade this part of the wave, you might be against what I'm saying about it. But let me break you down this. Let me give you my opinion, my point of view, and then you can see what I'm saying, that this one can be very, very extremely dangerous for a lot of traders. And obviously, you are more than happy to leave your point of view in the comment section below. I'll be really, really happy to see you guys having a different point of view on this. But that's pretty much how all these evolutions started happening. And then now everybody's are focusing over here. So now the question is, how do you take the advantage of this? And how do you trade that? Or what are the criteria needed in order for you to be part of this wave? This is exactly where the liquidity tab I was telling you about, guys, in the introduction comes into play now. So let's start deep diving into the different type of liquidity and how to use them on your advantages. So we have over here, if I scroll down here, I literally made already the drawing for you guys so you can clearly see what is going on over here and what are the very common type of liquidity that you can face every single day on your daily trading, right? Day-to-day trading and every time, every moment. So what are these? Common type of liquidity are this one over here, okay? And key type of liquidity for greater results, well, I'll break you down in a bit, but let's start first understanding the importance of this type of liquidity. First, we have support and resistance that are same as equal highs and equal low as well. They become liquidity because you have price tapping in one relevant point more than 2, even 3, sometimes even 4 times. That means that most of the people that are entering in the market over this level over here, they're putting their stop loss somewhere around here, right? Creating tons amount of liquidity above this specific line. The same goes somewhere below this zone as well, okay? So this is a very common type of liquidity. Then another one is the trend line liquidity. You have, again, 1 touch, 2 touch. Already on the second touch, people started putting the stop losses below this low. So you got a lot of money fluctuating below this level. The same over here, build-up range liquidity. Now, you might be wondering, what is the difference between this and this? Well, on the support and resistance and equal high and equal low, what I've noticed is that when a support resistance zone is very strong and is very good, and you can see the price comes here, taps, and runs away immediately. There is a very, like you can have a very clean type of price action that gets away from a support and resistance zones. While on the build-up range, this is the most confusing one. Why? And this is the one that probably has one of the large amount of liquidity within the range. Why? Because you can see the way I have the price action over here is not as clean as this one. So what happened is that price start consolidating for a very good amount of time in a specific zone. Usually this can be like distribution, accumulation, or reaccumulation, redistribution. If you guys trading Wyckoff, if you know about Wyckoff, that's one of the key part of the Wyckoff. And here, what happens is that you have a lot of traders that get confused because first, if you trade, let's say SMT or structure, you have this, for example, high that gets taken out, this low that gets taken out, this low that gets taken out, but price still stays within the specific range, okay? So this has the most amount of liquidity within all of this pattern. Why? Because once price gets out of this zone, it explodes in a way that you can literally, guys, go on the chart and you can see that. And that's why I'm saying, like, as a part of the Wyckoff framework, this is one of the very known and very used one because that's what happened when you see price like running away from the specific level. And then lastly, we have the structural liquidity, which is the very, very common one because every higher low that you have, you always have some sort of liquidity above and below, resting to these lows and highs, okay? So why it's important for you to know this is because when I was telling you guys earlier about the smart money concept, they were taking this type of part in consideration before they were taking even the trade, right? Remember that I had a pattern over here where I showed you guys that when price was taking a high in one side and then was breaking the trade, you were taking the trade based on the mitigation. So then you're following the trend, right? The same over here. If price comes down over here, takes the liquidity, goes up, breaks the structure, then you can take the trade from over here. Now, I might be wondering, okay, if these are common type of liquidity and basic liquidity, why is it showing this to us, right? And the reason I'm doing this is because not everybody is using liquidity to trade. Some of them are still using structure. Some of them are still using smart money concept, like in this case. And then the same goes over here as well. So if this breaks above, takes the liquidity, breaks down, then you can take the trade. And the same goes over here, takes the liquidity, you can take the trade on the mitigation, and then jump on the other way around. Now that we discussed about the common type of liquidity, let's go down here and try to understand what are the one that can give you the greater results. Okay, now I know it seems like, what the hell is that? He has all of them equal over here, like the same, identical, but trust me, shortly everything will make sense to you. This one, by the way, is going to be the tips, the bonus one that I wanted to add among all this type of liquidity. Now, what can you see clearly over here is that they all look identical, and mostly they look like this one over here. So you know where I say liquidity in here, structural liquidity? Well, this type of structural liquidity sometimes, okay, can be referred as session high and session low. So in this type, the first one, liquidity, right? You can type it down. The 3 type of main session we have, which is the Asian session, right? Then you have the London session, and lastly, you have the New York session. These 3 sessions their highs and their lows are extremely important for you to be aware of when it comes to intraday trading. Okay, when you're trading intraday, they are a must. And there is another important factor within these sessions that I'll discuss at the end of the breakdown over here, because here there is something that people don't have it when it comes to the other liquidity. Now, what is the second liquidity? The second liquidity over here is pretty much going for the previous day high and day low. All right, so we have the previous day's highs and we have the previous day's low. And why they are important is because as an objective for the intraday trading, if you are trading intraday, you don't only have the sessions trading like Asian high, London low, New York high, New York low, but as the main objective of any single trading day is for price to take out any previous day high and previous day low. This is a must, and it happens all the time. If you backtest on a chart, you can see that happens every single time, every single day. The same goes for this one as well. Then we move to the one that is not for people that trades like intraday, but this is more for, let's say, people that want to hold more than that one day to another one. And you can imagine this is going to be the weekly highs, right, and lows. Now, this is something that you need to be mindful about, not just because if you have a trade that you're taking and you're holding this for like 2 days or 3 days, but because if you want to do like high risk to reward, like the one I always show on my chart, on my channel, you can literally take this type of trade, something somewhere below here in a smaller time frame. You can literally make 1 to 20, 1 to 15 if you know what is the objective of the market for the week. So same as over here, you had days highs and low for objective of the day. Here you have it for the week. So you can now guess that the very next one is definitely going to be what? The monthly, right? So we got monthly highs and lows. So this is like very, very important. Again, same as the weekly one, especially if you're a swinger or if you're someone that's trading 4 hour, 1 hour and above. Okay, because not everybody trades intraday, not everybody trades like within few days. Some people they swing as well. And if you want to swing trade, you have to be mindful, you have to be aware of where are the monthly highs, monthly lows, and why it is important for you to target towards that direction. A lot of people, they use these highs and lows not only as a target, but also for a bias. Because of course, when you know where the target is, you also know what the direction is, right? There is one important factor that I mentioned earlier over here that is very crucial when it comes to trade this type of liquidity. And that is the factor of timing. Okay, the time. Yes, exactly. So this is what I'm going to do now. I'm going to be breaking down to you guys what are the criteria, what are the importance of every single of these highs and lows within weekly, monthly, and within the day, and how you can take the advantage out of every single one of them. When it comes about the timing, okay, what you have to be mindful about is that when I said over here, you got build up, or you got trend line, or you have a build up range liquidity, if you see any of this type of liquidity happening within a specific time window, so before any session opens, in this case, Asian session, London session, New York session, there is a high probability that if you have, let's say, and that's happened actually a lot, I made a lot of video about it, most of the time you can see this type of liquidity or this type of liquidity happening within Asian session. 100% you will see always happening there, like most of the time. And then what happens is that London, as soon as it's 8 o'clock, in this case I'm talking about UK time, you can see that the London session will most likely take out the liquidity of Asian high or liquidity of Asian low and then run away to the other direction. And this timing factor is so crucial because this is what helped all these traders that are trading the inducement on knowing how to take the trade when you have pretty much this pattern that we discussed earlier, right? So, you know that I say to you guys that if you have liquidity and a lot of people now trading this is the one that use and understand it thanks to this factor over here, which is basically the factor of timing. You use the timing. So if it's New York open, can happen the same. London can create build-up of liquidity and New York can take out the liquidity. Can be Asian and London can take the liquidity and then run away. Okay, so that's why in this one over here is extremely, extremely important to be aware of this type of liquidity. Now, moving to the next one, the days highs and lows. Why they are important is because that allow you to do something very, very important, which is understanding that the objective of the day has been fulfilled. Therefore, if you are somewhere around here, what do you guys think is going to happen? Will you still carry on going for a buy or will you be going for a sell now? Well, if the objective has been met, most likely even here, right? If the timing aligns as well after the day's highs and lows get taken out, then the likelihood for you to see price going down is extremely, extremely high. Why? Because the objective has been met and now price need to retrace according to the structures as well. That is literally telling you higher high and higher low, right? So we need the retracement. So understanding when the previous day's highs and lows get taken out will definitely allow you to know whether you should be carrying on buying or whether you should be carrying on selling. And this is very important because I see a lot of traders that trading, going with the trend, and then when the previous day highs gets taken out, they still carry on taking the trade. And the next thing you know, they hit a stop loss because price, instead of going up, it's just retracing. But they don't know that now this was important because of the previous day's highs low. Therefore, this liquidity that has been taken is extremely important. And then you can guess the same thing happens over here as well. Weekly highs and low. You do the same exact approach. The difference between this and this one is that when this gets taken out, what do you guys think is going to happen? Well, now, first thing first, if structure-wise, this gives you the retracement same to this one, in this one, you can actually make more returns than the one you could have done over here. Why? Because just imagine, this is a weekly high, weekly low. That means that it took 5 days for price to reach above this specific high, take the liquidity out, and then start retracing. Now, this retracement, it might look smaller within the weekly time frame, but if you go to 4 hour, 1 hour, or 5 minute, or M1, this range over here is a hell amount of pips. Therefore, you know, if you're taking a trade after the weekly high and lows get taken out, your probability of taking a trade with a high risk to reward is extremely high. You can do that. And I used to do that a lot, right? And then lastly, of course, if we move to the monthly high and lows, what do you guys think is going to happen? It's the same thing. But again, this one is the one that going to give you even the most extreme risk to reward. Imagine you were somewhere around here and you take a trade in M1, M5, and you hold that swing for, let's say, 30 days or 20 days, or even if you take it in the middle over here, right? I can guarantee you that those are the trades that you can make 1 to 20, 1 to 30. And it's not a joke, okay? And the same goes for the retracement as well. Now, the way I see the advantages within this 1, 2, 3, 4 type of pattern, let's say liquidity, is that this is definitely good for someone that's scalping. This is okay for scalping. This is okay for high risk to reward and some sort of swinging. And this one is swinging and high risk to reward. However, the most beneficial thing, and this is the one thing that I do a lot, is that this one and this one, I never take any counter trend. And the reason for it is because if you, let's say here, if you take a trade with 3 pips stop loss or 5 pips stop loss somewhere around here, okay, where do you guys think how far this can drop to? If this is a session high and session low, just think about it. How many pips can a specific session do to you? Probably 10, probably 20, probably 30, right? So if you enter already with 5 pip stop loss somewhere around here, how much or how far do you think you can make it before price comes here and then keeps going higher? Yeah, it can keep going down as well, of course, but you don't know. Your likelihood of this hitting a stop loss is extremely higher compared to one that you're taking over here and over here. Why? Because here you are entering in a retracement of a very high time frame within a smaller time frame. While here you're just entering, yes, this smaller time frame, like M1, for example, but the M1, right? The difference of the timing between the session and between the structure is not that big. Therefore, you cannot expect major gains coming out of it. And that's one of the reasons I was saying earlier that I don't trade based on this type of liquidity. I'm still using, I don't actually trade liquidity at all, right? But I do use them sometimes as an extra confluence. And I go mostly for this one over here because I try to understand where they are within the higher time frame narrative. In this way, that allows me to take this type of trade all the way from here, and then from here I can buy again. Do you guys understand why it is important for you to understand this type of liquidity? Okay, and how that works? The same goes over here. Very nice trade over here. Actually, you can take multiple trades because it's a monthly. So you just go with the structure and then you can take again multiple trades towards the upside. So as you can see, I put so much more emphasis. I explained to you guys better this type of liquidity compared to this one because this one over here, they do give you some great results. While this one, okay, yes, as I said, I use them in a high time frame, but in a smaller time frame, for me personally, they are useless because yeah, you can scalp with them. And this type of pattern you will see happening all day long. It's a must. It needs to happen within the accumulation, distribution, and all of that. However, these one here are more objective compared to this one. Because this one, for example, you don't know when market can create this type of build-up. Yes, you can use the timing as I said before. So if you see that during the session this happens, then you know that you're about to take the trade. But when you jump on the chart early things in the morning, you already know what is the daily high and daily low, right? You already know what is the weekly high, weekly low, and monthly high, monthly low. They're already giving you a perspective of where you should be going or where you should be targeting for your trades. Apologies for the alert, but I got so many alerts left all around my charts, and probably a TP or loss. I don't know. I'll check it out later. Anyway, now we move to this one. This is the bonus tips I wanted to give you about, and this is something that I'll discuss next time, because now I know I gave you so much information. So the best thing you should be doing, guys, is going to the chart and backtest it. But this one over here, I'll break it down next time, but I'll give you the hints. This one over here is it's very famous now called the SMT trap. Okay, so this SMT trap is basically SMT trap, right? So it stands for smart money, okay, trap. Now this is getting very, very, very popular. You might be thinking, oh, maybe he's talking about the pattern that I showed you guys earlier, right? So let me show you 1 second. Where is it? This one over here. You might be thinking that I'm talking about this one over here. No, I'm not talking about. Yeah, this is a smart money trap as well. Exactly, it's a smart money trap as well. But this one, okay, there is a very solid narrative in order for you to understand how this happens. Okay, and I'm gonna leave it to you with this, because I want you guys to think about it. I'll make another video on this one, because this requires a lot of explanation and a lot of breakdown. I have to do a lot of charting, and I need to show you on the chart for you to grasp this better. But this is emerging a lot now, because all the people that trading smart money concept, smart money trading, now they're getting trapped, because as I said before, previously, when I made this breakdown over here, a lot of people retail from this type of pattern trading, they are moving to this one. So there's a lot of liquidity, and a lot of people are still learning this concept, right? Including myself, they're still doing it. However, what started happening is that this is now becoming an objective, right, for people that trades this type of pattern over here, making for them SMT as a target. Okay, so what you can do is, like, based on everything that I explained to you guys so far, try to understand what might be this one, and give me an answer on the comment section below. From your point of view, what do you guys think this SMT trap can stand for? And I'll see who any of you, if it's right or wrong, or has that point of view. I mean, actually, it's not right or wrong, but I did a lot of hours of backtesting and understanding what is smart money trap they're referring to. And also, I made a video about inducement liquidity trade, and I made a video, and on that video as well, I told you guys that I've learned this type of things directly from the source itself. So I know pretty much what is this stand for and what is the right answer for it. But still, I would like to see your point of view. And in the meantime, if you guys want to know more about the differences on how to take the advantage of liquidity versus structure, how to trade that, make sure that you watch these 2 videos over here where I show you why I love the most trading the structure compared to the liquidity, what are the advantages, disadvantages, and how you can take the same advantages as well. Make sure that you watch them, otherwise you're going to miss out big time. See you to the next one.